Today, we're going to look at the recent tariffs and how they impact the semiconductor industry, with popular names like Nvidia and TSM taking a huge hit recently. I will also make a bold prediction. I believe the semiconductor market will completely outperform the market over the next 5 years, even with the recent tariff news. Let's jump in. So first, let's learn an overview of the tariffs and how they're impacting the overall semiconductor space. Even though semiconductors were officially exempt from the new tariffs list, the broader ecosystem wasn't spared the market fallout. Popular semiconductor ETFs, SMH, dropped nearly 9% on Thursday, the day after the announcements. Investors seem spooked by the possibility of indirect ripple effects. The global supply chain for chips remain deeply intertwined, with countries now facing reciprocal tariffs of up to 34%, like China. So while there is no direct duty on semiconductors themselves, components, manufacturing equipment, or end products that rely on these chips can still see cost increases. This complicated web of taxes and cross border manufacturing may squeeze profits for semiconductor partners in consumer electronics, automotive, and data centers, ultimately feeding back into the chip market. Now, directly, chips appear to be safe for now, given the stated exemption for semiconductor imports. However, the indirect impacts could be significant. First, if customers in automotive or consumer tech face heavier tariffs on steel, finished devices, or other essential components, they might slow production or pass increased costs to end consumers. Lower demand for products translate into lower chip orders. Second, potential retaliatory tariffs from other countries could suddenly target UX exports, including semiconductors. Lastly, macro uncertainty can depress broader tech spending, and these risks aren't trivial. But the forward looking story for semiconductors remain bright, in my opinion. Because despite the current market jitters, the core drivers for semiconductors are still powering ahead. Think artificial intelligence, autonomous vehicles, data centers, robotics, and overall tech innovation. These trends aren't slowing down anytime soon. In fact, AI and machine learning workloads are exploding, requiring ever more powerful semiconductor solutions. Even if tariffs raise short term costs, the hunger for better technology likely outstrips any long term slowdown. So, sure, the near term might be rocky, but the next few years still look like a runway and not a roadblock. Now, my prediction. I'm personally quite bullish on the semiconductor market long term prospect. My bold prediction over the next 5 years is chips could deliver an annual return of around 15 to 18%. That's way above the normal market posting. Yes, volatility will be very big part of the deal, especially in the first year or two as we see how these tariffs shake out. We might see wild price swings of 10 to 50% in a single quarter if trade partners retaliate or inflation flares up. Still, if you can stomach some ups and downs, the market positions in AI, data centers, and high performance computing makes it a prime candidate to rise above the turbulence. Quick recap: tariffs, semiconductors got an exemption, but indirect supply chain risks remain. Growth potentials: AI data centers, autonomous vehicles, robotics, and other innovation tech have a bright future. And yes, I'm expecting at least 15% annual growth for semiconductor stocks over the next 5 years, despite the market roller coaster. At the Motley Fool, your comments make us all smarter. Please comment with your own research and insight and tell us what stock you want to see the Motley Fool tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy now.